Hello and welcome to Choose FI. Today on the show, we have my good friend Scott Trench, who is the CEO of BiggerPockets. He's also the co-host of the BiggerPockets Money podcast, along with Mindy Jensen, also our good friend. So yeah, we have had Scott on first way back in episode 63, and then again in episode 312. And I just touched base with him recently because it's been way too long. And we decided, of course, we'd love to have him back on. And he sent me two of just the absolute best ideas for a podcast episode. And I was blown away. And even though it's kind of like a cardinal sin of podcasting to do two completely different ideas in one episode, I said, we absolutely have to do this. So we are going to get right into it. And with that, welcome to Choose FI. All right, Scott, welcome back to Choose FI. It's good to see you, my friend.
Good to see you. Thanks for having me back on, Brad.
Yeah, this should be fun. So, like I kind of alluded to at the beginning here, we have two amazing ideas for an episode. So, first, let me set the stage and then we'll kind of rock and roll with this. So, the first was actually an inversion of how we normally think about FI. And whenever I hear inversion or invert, I think of Charlie Munger, who's talking invert, always invert. And it was, how would you invest $1 to $2.5 million if I handed it to you in cash? And I think your idea here is to work backwards from that point and see how ultimately, because we're not working that way in real life, how you would get to that point. And I think a lot of us just kind of fall backwards into a portfolio that is less than ideal. So that we're going to talk about first. And then, of course, there's some interesting things going on in the world of real estate, which is obviously CEO of BiggerPockets. You have the pulse of real estate and with interest rates specifically. So can't wait to dive into that. But let's start with this first one. So this inversion. Talk me through, because I think you've really thought about this over a bunch of your episodes on BiggerPockets Money. So I'm going to just throw it to you to lead the way on this one.
Yeah, absolutely. I was talking with someone recently, and we do this a lot on our show with this Finance Friday episode where we talk through folks' financial positions. But anyways, I was talking with this person privately, and they were walking me through their portfolio. Hey, I've got a $3.5 million net worth, about $1 million in debt, all this kind of stuff. And the discussion was, how do I generate $50,000 in passive income? At first, I was a little taken back, like, hey, $50,000 in passive income. Well, you open up a CD at Ally Bank and you put $1 million in, and you're pretty close, right? I think it was 1.3 at current rates. And I realized what was going on here was this person had put $1.5 million into their retirement accounts. They had $700,000 after tax brokerage. They had a couple of rental properties that were essentially cash flow neutral with the way that they had levered them, and life insurance and other stuff. We can get into that at a different time. But all this was managed basically through a financial advisor, and there was no freedom in that portfolio. And so I was like, okay, if they liquidated everything, they might have a portfolio of $2.5 million. And how would I just distribute $2.5 million across a new portfolio if it was in cash? I think this was a really interesting exercise to think through because, okay, there's one portfolio that's larger pre-tax and a smaller one after tax, but I think I'd rather have this portfolio. I'll make it stupid simple. $750,000 in paid off real estate, 1 to 2 rentals, generating $40,000 in cash. $750,000 in a debt fund or bonds, whatever you want to call it, generating 7% interest rate, which is very achievable in today's market. That's another 50, 60 grand. And then you have $750,000 in your stock portfolio index funds. Stupid simple. And then that leaves you with a nice $250,000 in your emergency fund to feel really comfortable. Which portfolio would you rather have? One is a larger amount. Sure, technically the right answer is always the larger amount because you can always play the games, but one frees you and one is a trap. These folks were making hundreds of thousands of dollars. So I think that that's kind of the story that generates this exercise. And what you can do now, before most likely you have a $2.5, $3 million portfolio, is think about that end state and say, what is that future end state 3, 4, 5, 7 years from now? And how do I back into that portfolio one chunk at a time? How do I aggressively build first the real estate or first the stock portfolio or even first the debt portfolio? Can I make some statements about that future portfolio that free me, right? Putting your money into a bond fund is not tax efficient. You're going to pay taxes on simple interest payments. But you're also going to get $50,000, $60,000 in cash. So these were some of the thoughts that I had coming out of this exercise. And I think it's just a really powerful framework and tool to back into that future state.
Yeah, I love that thought exercise because we often, like I said at the outset, even though we're saving significant amounts of money and we're so far ahead of the game, we're not thinking holistically. We're just doing whatever. We're maxing our 401ks or pumping money into index funds, whatever it may be. But yes, there's no concept of what will this look like down the road? A, what do I want it to look like down the road? B, and how do I bridge that gap? And or is that even possible? Is it tax efficient to do that? Or do I need to do it now? And I think that's what's cool about this particular thought exercise. So I just want to actually go back to the original, like the non-optimized version. Talk me through that again, just to set this up even more starkly. I think the audience might need just like a better understanding of that and maybe how that looks more like their own portfolio, possibly.
Yeah. I mean, look, I think this is a traditional output of middle-class financial planning, right? And, we don't want to get the specifics of this person's portfolio. We can, but it's more the concept of if you're doing it the traditional middle-class way, the right way, you're going to buy a house with a nice big mortgage. You're going to pay that mortgage. That's going to be your biggest investment. That's where most of your liquidity goes into doing that. And then every month, you're going to automatically make that mortgage payment and you max out your 401k contribution. And if you back into that on a long time horizon, a decade or two, you're going to end up with hopefully $1 million in that retirement account and maybe $500,000 to $1 million in your home equity over time. And then you have $20,000 in cash, $10,000 in credit card balance, and it's not a freeing portfolio. There are some efficiencies about it, but I think that's the crux of the problem there. And you compound that with traditional financial planning and getting sold life insurance products and having the asset under management fee. And that incentive is to build a portfolio that continually compounds and generates the AUM fee for the financial planner. So that's the trap to avoid right now when you're getting started with your portfolio, and instead build something that can actually produce freedom. And one of the trade-offs with freedom, I think, is a little bit less efficiency. We don't have to go, necessarily the whole way to Dave Ramsey and be debt-free and all this kind of stuff. But I think that if you're optimizing too hard on the tax front, or for example, if you're trying to lever your returns in real estate too consistently over the long run, it can be very difficult to actually generate cash flow. The 4% rule stock portfolios, very hard to actually generate cash flow. We talked to a lot of early retirees and almost none of them, I would say 95% of the folks that I've talked to who actually FIRE do not do so on a portfolio that meets the 4% rule strictly. Everybody's got an ace in the hole. They've got a big cash balance. They've got a real estate portfolio on top of that stock portfolio. They got a pension. They got a side hustle. Something else is going on there. And I think that's the way to back into FIRE. That's really good to think through what that ace in the hole or what that freeing portfolio looks like for you, even if it's not efficient.
Yeah. The efficiency, I think you're using air quotes here, which I love because, yeah, I think it's easy to get bogged down in, what is perfect or what is the way that I've been told FIRE has to be. And what we've tried very hard here at Choose Advice is to say personal finance is personal. And that's really, really critical that we don't get stuck into some very narrow dogma. So, right, you're saying produce something that can create freedom. And that's a wonderful quote. And I think also, like you're saying, incentives, which, incentives make the world, they run the world. And I think that's another thing that Mr. Munger talks about quite often in his brilliance. And as you're describing, a lot of these financial advisors that a lot of middle class or upper middle class Americans get kind of stuck with, they are doing things that are ultimately for their own incentives, which are increasing those AUM, like you said, these ridiculous life insurance policies that in most cases don't serve anybody but the person getting the commission. So that's really critical, just as like a mental model for us to consider is just always look at the incentive. Even aside from this conversation, Scott, that's just a really critical thing.
Oh, yeah. We can get into the financial planning thing, but I'm appalled at some instances that I've heard of with folks, because what the financial planner will do is they'll come in and say, oh, you should get life insurance, not for what you need to survive, but for all of the future earnings potential that you have. And here's that future earnings potential. So that's how you get sold like a $15 million life insurance policy, and you're paying 50 to 100 grand in some cases for those types of things in annual premiums. By the way, your life insurance seller, your financial planner gets 80 to 100% of the first year premium for that. That's a nice signing bonus for getting you as a client, right? That's, $40,000, $50,000 or $80,000, $100,000, depending on how big that policy is. And then there's the AUM fee. So if you have a couple million with them, let's call it $2 million. That's 1% to 2% going to the financial planner. It's 20 to 40 grand on an annualized basis. And what's the incentive there? It's maintain that portfolio, grow it slowly, don't lose money, and allow the golden goose, your portfolio, to continue laying eggs. It's a great way to achieve financial independence at an early age, is to become a financial advisor and get a giant signing bonus and a huge AUM fee.
Yeah.
So that's maybe a little harsh, but that's how I feel about a lot of this.
No, and I love the passion about it because it's really important. And we talk about these 1% fees and they don't sound like much, but when you talk about the negative impact of AUM fees over a 30, 40-year period, it is unbelievable. I mean, truly unbelievable. I've talked about this so many times. The audience is probably tired of hearing it at this point, but it's critical because frankly, the financial advisor you're investing with, in all likelihood, they're not going to just simply be in index funds at 0.04% expense ratio or, a couple of basis points.
They can't be an index fund.
They can't.
Otherwise, you cannot even pretend to justify what you're trying to do.
Right. So by definition, they're going to put you in an expensive fund to justify their genius, right? So you're looking at 2% fees in all likelihood, plus or minus, and they are not going to beat the market very simply over a 40-year period. The likelihood of that is, in my opinion, it's probably sub 1%. It might be plus or minus. And what that
Once
means
you factor in the fees, you have an 80% chance of not beating the market any given year, and you compound that out every year.
Right, over 40 years. Yeah,
it becomes an infinitesimally small number.
Vanishingly small. So we're talking about you're willingly giving, a measly 2%. But what that means over 40 years is essentially half of your net worth is gone if you had just invested in index funds. So I know we're obviously talking about a completely separate thing here with building a slightly less than optimal but cash flowing portfolio. But even if you're just going the traditional FI route, goodness, that's half of your net worth to that 1% AUM.
And then this is what I need to learn about, but I also fear that there's a really painful breakup if you ever want to get out of this relationship, right? I mean, you've sunk tens of thousands or hundreds of thousands or millions into your life insurance policy, right? And it's really hard to justify moving away from that sunk cost once you have built a small balance in there. And then if you want to break up on the portfolio side, there's the retirement accounts is one thing, but then you might have a large taxable event depending on how things go if you want to move out the after-tax portions of those. So it's really a nightmare, I think, at the larger scale here that I think you can really easily avoid in the early parts of the journey by just self-educating and building your own portfolio.
Yeah, agreed. And I do want to obviously go into in depth how you would start this from the beginning, because we're talking about inverting, but clearly there are people out there that, okay, how do we start this today? But I did want to just ask you two quick questions because I'm sure people listening are having them. So we're talking about a slightly different model on FI, which again, personal finance is personal. That's great. But like you said, most people that you've seen anecdotally have some ace in the hole. But I guess my question to you is, do you think that the stereotypically traditional FI path of, okay, I'm going to amass a significant net worth in the stock market, most likely in index funds, and pull out X percent, 3 to 4% of that per year, sell that amount, and kind of live off that. Do you see that as a viable strategy?
Absolutely. It's a viable strategy, and it has been used by a lot of folks. I think that, look, there's the formula, and then there's the opportunity, right? And so I think that that's really hard for folks. Every once in a while, you'll talk to somebody, and that, like, this is the crux of a lot of arguments about finance, right? Is some people are like, no, I need a spreadsheet, and it's going to map very perfectly into, if I save this much and get this yield, I'll back into this number in 15 years. And then the other school of thought is, I'm going to start a business and it's going to explode. And if I do that 3 times, one of them is going to work and I'm going to be done. And they're both right. Those are both valid approaches. Personally, my approach has been to use both, right? There's a consistent formula, and index funds are the underpinning of my personal portfolio. I also have real estate, and every once in a while I'll take a pot shot on something opportunistic. Every once in a while, I mean once a quarter, I attempt to do that. So if you do that every quarter, after 2.5 years, you've taken 10 shots, one's going to work. 9 out of 10 businesses fail, so start 10 businesses. Yeah. That's kind of the thought process that I have, and would encourage folks to think through is keep your index fund first, 4% rule portfolio. That's traditional. Like, that should be the underpinning, I think, of the FIRE journey for most people. And then also layer on these other things.
Nice. Okay, I can't let it slide. Talk to me about a pot shot. This sounds fascinating. I suspect we could talk another hour just on this alone. What does that look like? So 4 times a year. I know, obviously, that's on average, but what the heck does that even look like?
Okay, when I'm 23, it looked like I'm driving for Uber to see how much side hustle income I can make after hours. I attempted to tutor. I explored the idea of a winter gloves for driving business. That went nowhere. I explored a trenches tees business. Still today, when I log into Facebook, I see the BiggerPockets Facebook groups and then the trenches tees page, which never gets a view. Maybe someone will check it out now. One of the t-shirts had a Buddha purchasing a hot dog, and Buddha is saying to the hot dog vendor, make me one with everything. And the hot dog vendor is replying, sure, but change must come from within. Sadly, this never took off. I'm shocked. Then I bought a house hack. That one worked really well, right? Over the years, that's expanded. Like, I've written 2 books on the subject. Those have both gone on to sell reasonably well. Those took more than a quarter, but you get the theme here. Yeah. I've invested in various other rental properties over that period of time. I've invested in syndications and kind of learned those types of strategies. So as the time has progressed, I've been able to slowly compound a large number of shots and skills, and the hit rate is slowly starting to improve from perhaps 1 out of 10 to 2 or 3 out of 10 on various investments that I'm making, either with my time or money. And I think that's layered on top of the I'm going to live frugally and invest most of my cash that I'm generating into my index fund portfolio.
Yeah, that's brilliant. And I love the concept of the talent stack, which we've talked about since the very, very beginning of this podcast. And like you said, okay, maybe my rate went from 1 out of 10 or maybe even less to now it's maybe 2 or 3 out of 10. And I think, as you said, layering those skills, there's a significant through line of, oh, wow, all of those quote unquote failures, I learned something from each and every one of them. And it's funny, as you were saying that about logging into Facebook, it reminded me of, I have a bunch of these like unpublished pages of old businesses that don't exist anymore. I've talked about my firewood storage rack drop shipping site. I don't know if I ever remembered. I had one called Fire Pit Mart, which from the name of it, you can imagine it didn't succeed. I had an automatic pitching machines
Loved it.
drop shipping site too. So I have all of these as unpublished pages, and yeah, it's funny seeing like the kind of graveyard of dead businesses. But like you're saying, they're these, you take a chance and you never know when it's going to hit. You never know, in my case, when it's going to turn into Travel Miles 101 and then Choose FI, right? And
you have
I don't
one
think
business that worked. So you're 90% fail rate, apparently.
Yeah, I'm right about it. It's pretty wild. So the other kind of sidebar question I wanted, which actually gets us right into, okay, how would you do this? So you were talking about in the not optimized version, which is essentially normal people, right? It's middle class, but middle class people who are doing well, who are saving. So we're not like denigrating them by any means. That person ends up with, like you said, probably $500,000, $800,000 of home equity. I guess like the kind of question from the audience might be, okay, most people think of the home you live in as your quote unquote biggest investment, and that home equity as your biggest source of, net worth or investment. Like, how do you conceptualize that?
Yeah, this is nothing new. Rich Dad, Poor Dad, Robert Kiyosaki wrote about this 30 years ago. I completely agree with his statement that if your home is your biggest asset, you're in trouble, right? If your home is your biggest investment, you're in trouble. Your home is a liability. A paid off home is valuable in the sense that it lowers your cost of living. But until you get to that point, it's a negative drain in your cash flow. So you have a 30-year mortgage, you don't plan to pay it off. You have to generate more cash flow in a way that you're comfortable actually spending in order to actually pay for that. And that's the issue with the reliance on the 4% rule in practice. In theory, it makes perfect sense. But in practice, I meet very few people under the age of 65 who are actually comfortable selling off portions of their portfolio. There's comfort spending a minority of the cash flows generated by a portfolio. An index fund portfolio generates 2%. So you have to go pretty far past the mark to actually use dividends from an index fund portfolio to pay your mortgage, right? That's a hard mental leap for folks that are not used to that. And in practice, it doesn't happen very often.
Yeah, that's interesting, Scott. I wonder, does that bring up, so the allure of the dividend investors who, if you're on Twitter or anywhere on the internet, you see these, hordes of dividend investors who proclaim it's the best possible strategy. Whereas to me, it seems suboptimal. But I guess you're describing it as like this psychological play of, man, it is hard to force sell some of your assets. But if you're getting this mystical, magical free income in the form of dividends, even though we both know that's just part of your overall return, right? But if you're actually getting it as income, psychologically, it feels a lot easier.
Correct. Yes, I think that's a great way to put it. Now, where I would go with that is I'd go on the other side and I'd say debt. Debt is back. The last 10 years, debt should not have been a part of the conversation or investment thesis for most people attempting to achieve financial independence. What's changed is interest rates have doubled, right, in the last, for mortgages, for example, but the federal funds rate has gone up 400 basis points in the last year. All of the sudden, now you can get access to reasonably secure debt that is not outrageously risky, that generates a 7-8% return in many cases. And so that's what I'm noodling on. And I'm still work in progress in thinking through kind of how I want to put this into my portfolio. But like, imagine going back to that $2.5 million portfolio. Let's make it simple. You just take $1 million and you put it into 7% interest rate debt fund. That's 70 grand. Okay, that all of a sudden is way easier to internalize and actually begin moving on from the job and living that lifestyle you've been looking for. And it's not a ridiculously low return. Your spread between 7% interest and the 7 to 10% annualized return on the stock market compounding is not very large. The only issue with it is it's tax inefficient, right? It's just straight, simple interest. There's no long-term growth, and you're going to pay that, especially in the years where you're working. If you're trying to transition from a paid job to FIRE, you're going to be in a really high tax bracket and you're going to be doing it really inefficiently. My question I pose with this, though, is should you just be inefficient for a few years, get used to it, get comfortable with that hitting your bank account every month, and use that to pay the bills? And maybe that makes the ultimate transition really easy towards the end of that journey to FI.
Yeah, that's interesting. I wonder, and like you said, you're still exploring this. Obviously, this is the first time I'm really thinking of it on the fly here. Are there ways to make it where you can put that bond investment in a more efficient taxable umbrella, like a 401k or IRA or some such? Has that been crossing your plate?
A tax planner, I think, should and would give you the advice of, put the bonds into the 401k or the Roth, and that way you can avoid the tax. Again, the issue that I'm coming back with and what I'm trying to grapple through with my own investment philosophy right now is, well, that's great, but that doesn't solve my problem of actually generating passive income that I can spend right now on my lifestyle and fund early retirement for the next 30 years, right? And so that's what I think. I think there's like a trade-off that's blooming in my mind as I'm working through this, again, with my personal portfolio and inspired by this recent conversation, is should I just say, screw it, I'm going to pay the taxes and I want after-tax spendable liquidity. And that means that I'm going to pay taxes and it's not going to be efficient, but it's going to be effective in getting me to financial freedom.
Yeah, it's funny because it does go against like everything I've thought for the last handful of years, in that like my kind of buzzword statement is control what you can control, which is often a lot of our really cool FI strategies are tax minimization strategies, right? You talk about, okay, let's put everything in pre-tax as much as we can. And then we think there's a reasonable likelihood through Roth IRA conversion ladders and standard deductions and just the combination of not spending that much, that your actual tax liability could be minuscule, right? Your effective tax liability could be sub 5%, and in some cases closer to zero. So it's an interesting rethink. And I think that's how you're describing this, is a rethink for yourself. We don't have like a necessary answer, but it's worth exploring it as a thought exercise for sure.
Yeah, if I simplify the journey to financial independence into 3 phases, right? The first is this kind of discovery aha phase. People start there with lots of debt. They start there with several $100,000 in net worth, everywhere in between. But I think a lot of folks would relate to the idea of this immersion of like, oh yeah, that's what I'm going to do, is I'm going to go and become financially independent as early as possible with this. Then there's this grind period of accumulation where years go by, you get better and better at the skill of spending, at generating income and wealth. By the way, the skill of spending is a turn of phrase that Mr. Money Mustache used recently, and I love it.
Scott, I love that. So I actually posted about that in my FI-weekly newsletter. So we're recording this in early February, literally this past week's newsletter. And of course, I referenced the BiggerPockets Money podcast. That was like a lightning bolt to me, that episode with Mr. Money Mustache that you guys did, precisely because of the skill of spending. So keep going.
Yeah, absolutely. So yeah, we have this aha phase, right, which can last months to a year or two. And then you have the grind, which for most people will probably last 5 to 7 to 10 years, right? To grind your way from zero to maybe $1 million or $2 in net worth. And then you have this transition phase that also takes folks in practice several years. They're at FI, but it still takes them several years to actually build the lifestyle that they wanted to leave the job and build a lifestyle and build up confidence and stuff and those types of things. And I think, look, putting your money into a bond fund or a debt fund in the grind or aha phase makes no sense because it does not have significant upside. But perhaps for more folks that are in this transition phase, like that person I talked to, perhaps then is the time to maybe forget efficiency and all of this tax perfection and maybe just say, you know what, I'm going to build something simple that I'm happy with and know that my upside, I don't have to be efficient because I can go build a business after that, or I can go and work part-time or whatever, but I will actually see those funds hitting my bank account in a way that I can feel very confident and diversified in. So that's the thought starter that got me noodling and what I wanted to kind of go into today and maybe make some folks think.
Yeah, I like that. I really like it a lot. And so I guess just kind of to close this out, this part of the conversation. So you're clearly thinking about this personally.
Mm-hmm.
And maybe you might be the prototypical person to start thinking about this. Maybe where you are, obviously when we met you 6 years ago, you're the wide-eyed kid who's getting started. And obviously you had significant success, but now you're in your early 30s, I believe. You have a family. You have what I assume is a nice net worth, both through real estate and obviously you earn income that you're putting into the market. You have index funds. You are this person, right? You are the person that is on the path to this. Clearly, you're already ahead of the game in terms of the rental real estate. Okay, you're noodling on this, but if you were to put this in practice now, because I think that's the key that I want to leave for the audience, is if you decide to move forward, which you may not, but what would be the steps that you take, you believe, in the next couple of years to start laying the groundwork for this? Because, I mean, it's like a moving the Titanic type scenario, right? Like you already have a very enviable position. So it's not like, oh, poor me. But if you wanted to get there, what would that look like over the next, 3 to 5 years?
Yeah, so I think that's a fantastic question. Moving your portfolio is a big deal, right? Because it involves reallocation. And so my approach right now is I love my job. I have no plans to go anywhere. But the next phase of my accumulation, I'll probably ease off of putting it into more stocks and real estate, or at least change the percentage allocation of new cash that I accumulate and divert that to debt instead and lending investments. What that looks like, I'm exploring, look, one option is a CD. That's terrible. I'm too young to invest, put my money into CDs and take that little risk. But like, that's the easy button. So I've got to be able to beat that, right? I can earn 4.5% in my Ally Bank account if I put it in a CD. So what's going to beat that? Okay, the next is, and again, this is my amateur status here. I'm very eager to talk to more experts on debt investing for purely selfish reasons at this point. But what I'm kind of really leaning towards is, I'm a real estate guy. So real estate debt is something I understand. And I've been particularly interested in hard money, which is what a flipper would use, right? If you want to flip a property, a bank won't lend on it because it needs a construction loan. These loans typically take 6 to 12 months for the flipper to kind of complete the project and then resell the property. They typically are loaned at like up to 60% of the value of the property. So you do have kind of real estate as but the risk is if the flipper walks away or does a bad job, then you'd have to foreclose on this property and you'd have to finish a half constructed house.
Right.
So where I've been looking then is I don't want to do that. And lending several $100,000 is into one project would be a very big risk for me if I even could get that cash to do that. But there are funds out there of folks who raise $20 to $50 million of this from a pool of a couple hundred investors, and then they lend it out to these folks. And so what I'm looking for now is how can I find a fund that offers that in maybe a specific region of the country that is easy to foreclose on and has lender-friendly rules and regulations. And maybe, best of all, that person is a current flipper, has a flipping business, or used to flip, or has lots of contacts there. So if they need to foreclose on those properties, they can actually complete those projects and de-risk it for the investor. So this is where my mind has taken me lately and what I'm exploring. I'm looking at a few. I have not made any specific decisions yet at this time, but
Gotcha.
That's in practice what that looks like for my personal portfolio. And again, this is my quarterly kind of deep dive.
Yeah, I like it, Scott. I really like it. So I guess just to kind of summarize here. So this kind of perfect person's $2.5 million portfolio really has three major prongs plus an emergency fund. So it's rental real estate that generates cash, clearly. These debt instruments or bonds at, who knows, roughly 7%, which also then would produce somewhere 50K to 70K if you're talking 700 to $1 million. And then regular index fund investing. So it's not a wholesale change for you. It's just, right, for you specifically, since you already have the real estate, you already have the index funds, it's a question of, okay, these bond and debt instruments, I need to start thinking about that.
Yeah. And I think I will back into a portfolio most likely. That's where my lean rate is right now. So it looks more like that and less like just stocks, just real estate or whatever. But I to your point, I do think that another way to get there would be dividend investing and doing that. That's a skill I don't have and I'm not familiar with, but that would be essentially achieving the same objective that I am describing that I want to achieve with debt investing. Small business, whatever. There's other ways to do it. That's just one. And I think that opening your mind to, okay, maybe when I'm in my end state, my portfolio can be a little less efficient but more freeing, right? Because $2.5 million just in index funds generates what, like 50 grand on a good day in dividends?
Right, at 2%.
Yeah, with a Vanguard VOO or VTI ETF, you're going to generate like 1.8% dividend on that. That's efficient. There's a lot of research that backs up why that is perhaps one of the best ways to invest for the ordinary American, but you're probably not going to quit your job with that portfolio.
Yeah, it is interesting. So obviously to be continued on this. I love the thought experiment and I love really just kind of questioning these not preconceived notions, but maybe things that we hold as self-evident in the FI community. And it's always good to challenge your thinking. I think that's really critically important. So Scott, obviously you mentioned a bunch of times in there that you are a real estate investor. And I think that's where we want to land the conversation here for the last little bit. And there are, I guess, some things going on in the real estate world. I think all of us sense it, whether it's actually come to fruition quite as much as maybe I would have believed with the impact of interest rates. And I think that in and of itself is just like a really good launching point for, okay, real estate interest rates have jumped up, especially for single family homes. Now, of course, we can talk about investors and obviously that's really important, but for regular people like looking to get a mortgage on their home, their single family home, mortgage rates have just jumped up dramatically. And there's not too many components of what does your house cost per month, right? It's essentially loan term, principal balance, and interest rate. And when one of those components jumps up dramatically, my kind of in a vacuum assumption would have been that like housing prices would have started to fall or something insane like the 30-year mortgage goes to a 90-year mortgage. I'm kind of making this up. But at the end of the day, for me, it's always like, okay, what can most people pay in terms of their monthly mortgage amount? And that's what drives the home value. I don't know that there's any inherent value. It's to a large degree because most people aren't paying cash. It's a function of those three things spits out a monthly payment amount. And now you have one of those three that is dramatically higher. So anyway, I'll be quiet now since you're actually the expert, but I would have expected significant ramifications. And I'm curious, what are you seeing on the ground?
This can get very complicated very quickly. So you just let me know when I get going too hard and too energetically on this. Absolutely. When interest rates double, right, and effectively for mortgage rates, that crushes affordability. What has happened first is what we call this lock-in effect. You own a home and it's worth 500 grand, it's gone up 200 grand in 5 years or whatever it is, right? You probably refinanced, maybe have cashed out, or you at least originally financed it with a 3% mortgage. If you want to go buy that same house, you want to move down the block into an identical house, you'd buy it for 500 grand or maybe a little lower because prices have come down a little bit, but you're going to swap that 3% mortgage rate for a 5.5% mortgage rate if you're lucky, maybe 6.5% at this point in time. So what's happening here is you need to have a really good reason to move or to relocate or to exit that property. So millions, tens of millions of people are stuck. They're probably reasonably happily stuck with their current home because they've got that low interest rate mortgage and they still got a lot of equity. But you've seen transaction volume completely evaporate. Loan origination volume is down 70% since 2021, right? On an annualized basis. Transaction volume plummeted to multi-year lows in 2022 and late in the second half of 2022. And that will continue, I think, for a long time. I think we have a long time to dig our ways out of this. So what's happened, the reason you haven't seen prices come crashing down is because nobody's selling their property. And so that's this lock-in effect that's happening. We are still projecting at BiggerPockets that prices will come down 3 to 10%. That's a big range. So nobody really knows. There's so many factors that go into this. But we think that in the single family space, there's definitely likely to be a reduction in home values this year compared to 2022. Now, where the real pressure is mounting, in my opinion, is in the commercial space. So unlike residential, commercial mortgages, they use an agency called Freddie Mac to buy property. And those folks have 5, 7, or 10-year balloon payments. So the mortgage will amortize just like a 30-year home loan. But then after 5, 7, or 10 years, you have to pay off all the remaining balance and refinance. And about a third of that market, unlike 80, 90% of the single family market, is using variable rate debt. So when you have a variable rate mortgage, so here, I'll give you an example. Here, this will terrify you. Okay. And please, again, let me know if I'm getting too archaic.
No, this is
here.
Great, Scott. Keep going.
But I've got $1 million commercial loan on an apartment complex. That loan, it was at 3% a year ago. My debt service is going to be about $50,500. So I ran this math the other day when I was thinking through this. Today, if I were to take out that same loan for that same property, my loan service would be $68,000. That's an $18,000 spread. Most commercial property in this country, the average sells at around a 5% cap rate. That can be lower or higher. So that means I'll generate $50,000 in income in layman's terms on a property. So if I bought $1 million property, I generate $50,000. You can see how, and again, you would only buy like 60, 70% LTV, but that essentially would put you underwater in today's environment. And that's already starting to happen with many folks in the commercial space as their interest rates are rising, or the insurance that they buy to prevent those rates rising, called a rate cap, is increasing in price so much that they're not able to service their debt. And so these properties are getting foreclosed on or hitting the market. Cap rates, prices have not come down significantly in a lot of places, and I can't figure out why they haven't. And that scares me very badly in the apartment space. The best thesis I've heard is that there's a lot of folks that need a 1031 exchange a property in there, or there are folks that have raised a large amount of capital to invest in apartments and they're still buying, and that's keeping these things down. But just like in the single family space, transaction volume has plummeted in the commercial, all of commercial real estate, but multifamily is one component of that. So I think there are significant risks in this commercial space, but I think that your average homeowner has a chance of not feeling the hits of these interest rates on their home equity for a while, maybe ever. We'll see how that goes. It seems crazy, but as long as transaction volume stays low and folks feel stuck in their property, there's no reason to sell right now. And you don't have the same poor lending standards that you had 12, 15 years ago in the financial crisis. Everyone was reasonably qualified for these loans and mortgages that they got for their homes by and large. And again, there's no reason to exit that property. There will be no pressure to exit that property in a hurry like there was when those variable rates came due in the great financial crisis. So what do you think about that? What's your reaction?
Yeah, it's fascinating. So like I said, in my kind of run up to this, when I was describing, okay, how I expected it. And again, I use the term in a vacuum because intellectually, of course, prices are going to come down 20, 30%. You can see it on paper. But I think your point of people being locked in and me neglecting to realize, hey, this very obviously is a market, right? And if there are not enough sellers and people aren't forced sellers, then the prices by definition do not have to plummet. It's just that the inventory and the transactions are plummeting, essentially.
That's right. You own your home?
Do I own a home? Yes, I do.
Are you going to sell it?
No, not anytime soon.
You think prices are going to go down?
I think short term they conceivably could go down, but I guess I don't really care.
So that's the issue, right? That's the problem that's in the market with this. Now, where you are going to see a lot of pressure is on new construction. So we have 1.6 million new units coming online. About 700,000 of those are going to be single family, and the remaining balance is going to be multifamily. So that's going to be a pressure on rents for a lot of folks. So I think this is going to be one of the first years in a long time we're going to see rents decline on a nationwide average basis, which I think is a bold claim, but we'll see if I'm right next year.
Yeah.
But if you want to buy a new home, you might never get a better opportunity than this year because these builders have to monetize that inventory. They cannot sit on a brand new completed home, or if they buy lots that are ready to build on, and they buy that with that same type of loan that I was telling you about, hard money or what's called bridge financing. It's 8-10% interest rate. So they've got to complete those projects quickly and get out of them. So I think you're going to see builders really trying to monetize this inventory. They have to complete it. They have to keep their crews occupied. And so I think that it's going to be, you might have a situation where new homes are substantially cheaper than existing homes in a weird dynamic for perhaps a good chunk of 2023.
Yeah. Scott, how does that 1.6 million compare to a quote unquote normal year, if there is such a thing?
It is the most ever, or at least the most that we have data for. So, you may have heard that housing starts have been declining dramatically, and that is true. Nobody is starting a new project right now.
But they've already started.
It takes a while to build real estate here, to construct real estate. There's a permitting process in many places. It can take years or decades. So all this stuff that was started in 2021 and early 2022, that is going to get completed and monetized most likely. Now, there could be some of that if there's really big pressure on the market that goes under and it's not completed. But I think by and large, you're going to see most of that inventory monetize. And that's going to put pressure on home values and rents this year. So I think 2023 is a tough year for real estate. You can still make it work. There's some strategies, and that's where we come back to maybe lending is a good option in this environment, right? Your interest rate is higher than the cash flow you can get in many of these apartment complexes, for example. Maybe you lend to that apartment complex, let them take the first 30% of the risk on the equity side.
Yeah, very interesting. And that's why we always have to stay up on things, right? And reconsider as the facts on the ground change. I like that. So, okay, we talked obviously about both the single family, but then commercial property. I wanted to dive a little more into that commercial. So are we separating this as like apartment space from what most people, like when I heard commercial, I'm thinking of businesses and wondering what's going on in cities with now work from home. Are you separating those, or are we considering them roughly the same in this scenario?
Yeah. So commercial real estate has a number of different categories, which may include retail, industrial, multifamily, those types of things. And multifamily typically trades at a lower cap rate, a higher price than its relatives in the office, industrial, and other types of real estate because of the growth prospects in rents. There's a housing shortage, and long term, you think that rents are going to grow faster in multifamily or apartments than they would in office, for example.
Okay. So that cap rate, I'm sure there are people out in the audience who aren't terribly familiar. Obviously, they don't live and breathe real estate. Just give a real quick summary of what cap rate is and what that calculation is.
Yeah. So a cap rate is the income produced by a property. It's expressed as a percentage. So if I have a property that generates $500,000 in annual net operating income, the term for profit that we're trying to get to in the real estate world, and that sells at a 5% cap rate, you would divide that by 20 and you get to a $20 million property, right? So a low cap rate like 5% expresses the idea that you think that income stream is going to grow. If you thought that it was in an area that wasn't going to grow, you might have a higher cap rate, better cash flow. Like a 10% cap rate would be a very, very high cap rate, a very, very low price. A $500,000 property would be worth $10 million at a 5 cap, and it would be worth $5 million at a 5 cap.
Gotcha. Okay. So no, that makes sense. And right, so it's the net income after all expenses, and then
net operating income, which is a permutation on the word cash flow or income.
Right.
It's like EBITDA in the business world. So it can certainly be messed with. And net operating income is the standard term that we use in the real estate world.
No, that's good to know. And like you're saying, many of these properties, actually, they're going to see the impacts of the interest rate rise much more dramatically in terms of immediacy. Whereas my single family home, my mortgage is locked in for another 27 years and it's never going to change. You're describing many of these loans are under 5, 7, 10-year balloon payments. And then further still, 1/3 of them are on variable rates.
Correct.
So that compounds this even more significantly. And we're distinguishing between multifamily apartments and then potentially, I guess, like you said, retail and other types of commercial properties. But like I was kind of alluding to before, so we're already saying this interest rate thing could be dramatic. But now you have potentially changing work demographics as well. And you've kind of heard at the margins, like the whispers of, oh, what's going to happen to the cities? And are people really going back to work? Or has this, the last 3 years, changed the entire complexion of work forever, potentially? I mean, I don't know. I can make an educated guess, but it's essentially just a guess. And I'm curious, like, what are you seeing? And then like with this tie of, oh, wow, there's also this interest rate bomb potentially too.
Yeah. So I know my residential real estate space pretty well. The single family, duplex, triplex, quadplex market, that's my bread and butter. I am at most a journeyman in understanding the commercial space, right? And within that, I focus mostly on multifamily. So in office, I only have questions that I can pose, not answers that I can really hypothesize here. But I would say some of the questions I'd have is, this office situation, have folks been seeing this coming for the last 2 or 3 years and already begun to price that in? And that's why there's a higher cap rate, a lower price in office space than in multifamily. Or are there changes coming where you see a lot of folks that are re-renting office space and those types of things? Like we're not seeing office rents here in Denver come down from where we leased our property a few years ago. So I think there's questions there. Where I'm fearful most is in the multifamily space, because I think that for the first time in a long time, there's no reason to believe in rent growth, at least for the foreseeable future, with tons of supply coming online and a huge 26% increase in rental prices nationwide since the pandemic. So that's a big problem. Second, your interest rate is higher than your cap rate on average in the United States right now in multifamily. So what does that mean? That means I'm taking out debt that is more expensive than my cash flow. Normally, it's the opposite, right? What do you have to believe fundamentally as a market to make that bet? You have to believe that rents are going to explode or that interest rates are going to come down very rapidly and revert to where they were. I am very skeptical of either of those points. And so I think that what's going to happen is you're going to see cap rates rise. So cash flow is going to be less expensive than your debt. It's going to be 6.5%, 7% in this space on average, with debt at 5 to 5.5%. So that's what I think is going to happen. And if you raise cap rates from 5 to 6.5%, you decrease values by 20 to 23%. So this is very archaic. And again, I told you I could get this is very nuanced. I'm using a lot of jargon. You have to use all this jargon to understand how things are modeled in this space. But this is a very, very real risk to me that I'm trying to sound the alarm bell early and often here on this, because I feel like it's my job in the real estate space to say, we've had a great run for 10 years. You can still make money. There are still opportunities here, but be careful. And if you're going into commercial in particular, I like the debt side. I like these concepts of preferred equity, which are sort of like a similar version of debt, are senior to common equity. And I like the idea of, hey, if you have the means, buy it in all cash. Don't use any debt. Interest rates higher than the cap rate. You can always re-lever in a few years to take out debt against that. And you can just chill on your cash flows with very low risk in that situation.
Yeah, that's interesting. I want to dive into that. But first, I'd never considered how you describe the lower cap rate as almost inherently what you're assuming is there's going to be higher growth. So my brain immediately goes to growth versus value stocks, right? And I think about like Tesla that's trading at whatever it is, 40 times earnings, as opposed to most car companies that are at 5, 6, 7 times earnings. And what's baked into that, obviously, is probably a little exuberance and insanity. But a lot of what's baked into that is those investors believe that it's going to grow dramatically. And I never would have made the leap to rental real estate before you described that. That is something that's like a commonly held understanding of cap rates. That's what you're describing?
Absolutely. The cap rate in Phoenix, Arizona on a nice complex will be dramatically lower because people expect more income growth than the same complex transplanted into Memphis, Tennessee, for exactly the reason you just stated, right? And so that's commonly held. The United States as a whole is very bullish, at least in my interpretation, on future income growth. Or again, the counterpoint is lower interest rates, because you also avoid any of this problem if interest rates come back down. And again, I think those are both big risk flags for me. So if in my scenario, with cap rates rising from 5 to 6.5%, that's a 23% decline. That's a crash. That is a definition of a crash. And most of these folks are levered at 60 to 70% LTV on these properties. So that wipes out most of your equity, more than half of your equity from a current state for an average equity holder in one of these places. That's a big problem. In the residential space, the same logic could apply, but I think the reality of the situation is that you only invest in a commercial asset for the future income stream. People will say they have all different types of reasons, preservation of wealth, tax, whatever, but you're buying a property for the future income stream, fundamentally, in every case in commercial real estate. Almost every case, right? There could be somebody who wants it to store their belonging, I don't know, whatever. But in residential, you don't have that. And so you're not necessarily buying or keeping your home because of a hardcore financial decision. That's based in an investment thesis. So that's the reason why I think you're going to see less supply come online over time. And at some point, unless we get that growth or those interest rates coming back down, I think you're going to see pressure in the multifamily space that is not going to be the same in the single family space. And I'm worried that could be this year or early next year.
Yeah. All right. Well, that is something very much to keep our eyes on. But I did want to, just the last point, wanted to go back to what you said a minute ago about potentially buying properties all cash. And it's interesting to hear you say that, right? As the CEO of BiggerPockets, I am not surprised, but I think a lot of people might be, because you hear a lot of real estate investors who are quite outspoken about how essential leverage is, and they're just extremely cavalier about it, as if there's no potential downside. And I think anybody who's lived through any type of financial crisis over the last, certainly you described the one 2007, 2008, it's nice in theory until the proverbial stuff hits the fan. And I think it's very easy for people to say, oh, of course, leverage is important. Whereas the two rental real estate properties that I own, which I dip my toe into, I bought those things in all cash. And I'll tell you, I sleep very, very well at night, and they return wonderfully. And there's great allure to that to me. So it's nice to hear you give the counterpoint. I'd love if you could expand on that.
Yeah. So here's a shameless plug. Go on the BiggerPockets calculators, right? Our rental property calculator, and run a deal. Pick a deal that you think might look good in your market and run it. We use one example with a loan and one without the loan. And depending on what you assume, you're going to find probably more often than not that buying it with no leverage is going to have a higher return on investment over the next 5 to 10 years than buying with leverage with a lot of properties. That is a problem, right? That should make you feel uncomfortable with that. That was not true 2 years ago because interest rates were so much lower. You don't have to believe a very aggressive appreciation assumption to justify buying a property with a 5% cash on cash return, the equivalent of NOI, a 5% cap rate, at a 3% locked in 30-year mortgage. So there's this interesting predicament. I have my portfolio. My portfolio is leveraged. I still sleep well at night because it's all at 3%, 3 to 3.5%. I'm stuck with that portfolio. I can't refinance it right now. If I sold it and 1031 exchanged it, I'd be trading my great low interest rate debt for higher interest rate debt. But going forward, it may make sense to buy all cash. And again, I think this is another investment reason why you're seeing transaction volume so much lower right now than it was this time a year ago.
Interesting.
It's just harder to transact. It's harder to get your hands on money in those situations. So a lot of fun things to noodle on. And I think, yes, in BiggerPockets is a community. I am a voice in the crowd of BiggerPockets, which is why I think it's such a cool area. But some of the folks are very, very opinionated on going big. And some of those folks have gotten very, very wealthy in the last 5 to 10 years, much faster than I have. If I had gone big in 2014 and really levered up and gone off the races, I'd have millions more than I do today. So I missed out on that. My approach has been buy one property every 12 to 18 months, stabilize it, self-manage, or, hybrid with a property manager, those kinds of things. And I've been very conservative. I try to be very respectful of real estate. I know that it's a good investment over 30 years if you leverage it reasonably and manage it well. But I also know that wealth potential over 30 years evaporates if you go BK in the meantime.
That is very, very true. I love the balanced approach to it. And I think to each his own. At the end of the day, like we were saying before, personal finance is personal. There are people who have done very well with that. And there are people who also are more psychologically suited to going big. I think if I know myself, I would say I certainly am not one of those people who's psychologically suited to it. So I personally love your approach better. And I think for me, it works. And I guess where I'm going with real estate is I'm still at a crossroads. Do I buy that third property? Do I buy that fourth property? So far, I've had success, but it's a small sample size, both in terms of just 3 or 4 years and just 2 properties. It's still an open question. So like you're saying, a lot of this is to noodle on. I have my own things to noodle on, just as many people listening to this are considering real estate. So Scott, thank you so very much for being here. This is amazing. As always, people can find you at and around BiggerPockets, the website, and BiggerPockets Money podcast, which is phenomenal. Anywhere else people can reach out to you?
Those are great. And you can also find me on Instagram at Scott_Trench.
Awesome. Scott, thank you for coming on, and love to have you back sometime soon after, we'll continue noodling on this and we'll give an update.
You can make fun of me next year when a crash in commercial real estate never happens.
Well, we shall see, my friend. We shall see. All right. Thanks again, Scott.